I think, there we go. All right. Sarah, do you want to set up the screen for us so we can see our two speakers? Rudy and there we go. There's Rudy Flores. All right. So I want to introduce our presenters today. As many of you know that have attended this in the past, this is set up as a forum where we have an opportunity to I'll ask some questions of our panelists and then we'll go back and forth. And if you have questions or anything you want to provide information on, please don't hesitate to include in the Q&A section or even the chat box. We do have that set up so that you can put questions in for our panelists. So I'm going to start with introducing Rudy first. Welcome, Rudy. Rudy has been in the real estate industry for 6 years and has sold over 140 million in gross volume and served 373 families in the same time span. Very impressive. He is a husband and a father of 3, the team leader for the Flores team with his wife, and they've run this group consists of 18 agents and 3 administrative support staff. He specializes in helping families buy and sell real estate and mentoring new agents to achieve success through leading by example, living life with discipline and purpose, with a focus on creating a meaningful client experience and building systems for long-term fulfillment. I am passionate about empowering others to achieve their personal and professional goals. Welcome, Rudy. We're thrilled to have you on this morning.
Thank you guys for having me on. Honored to be here.
Our second presenter is Parker Ross, and many of you may remember Parker joined us a year ago. Parker is with ArchMI, which are also one of our sponsors today. And welcome, Parker. It's great to see you again, and Parker always brings a lot of great information. Parker Ross is the Global Chief Economist for ArchMI. When I should say Arch Mortgage Insurance, for those of you that don't know what MI stands for. Parker is responsible for overall economic surveillance and forecasting for the Global Mortgage Group. Additionally, he has assumed ownership of the Housing and Mortgage Market Review, which presents a detailed weekly analysis of housing and the economy and its associated quarterly housing market webinars. Parker joined Arch in 2021 after working at JP Morgan Chase & Co. for 6 years, most recently as the head of corporate economics team. Before JPMC, he monitored the residential and commercial real estate markets for AIG in the office of Chief Credit Officer and has nearly a decade of experience as a housing economist at the U.S. Department of Housing and Urban Development. Parker completed his undergraduate and graduate degrees at University of Colorado, where he earned a bachelor's degree in economics and a master's in economics and finance. He is the active member of the National Association of Business Economics, the New York Association for Business Economics, and the American Economics Association. Thank you both, gentlemen, for joining us. We are thrilled to have you both. And I'm going to kick it off. Parker, I'm gonna lead with having you share a little bit about what you saw in 2024. Any big surprises, or gosh, no, when we talked a year ago, this is what we were anticipating.
I think there are a few curveballs this year. We were definitely expecting mortgage rates to probably be a little bit lower on average over the course of the year than what we got. I mean, the presidential election was some excitement that I don't know that anybody could have predicted how that was going to go down. Not that that has implications necessarily for 2024, but certainly for 2025. The big thing is, we're still kind of in a holding pattern on the housing front. So we thought that this might be a year where we could break out of that doldrums and have a little bit more upside, but instead it was more just kind of treading water and waiting for 2025 to hopefully have some of those Fed rate cuts pass through a little bit more to mortgage rates and have lower rates overall and a little bit more housing activity. So there's certainly signs that there's more cuts on the horizon, but not necessarily that many priced in at this point. There's only about 4 more rate cuts priced in by the market over the course of the next year, which feels about right to us. We're thinking they'll probably cut one more time here in December, and then a couple more times, or once a quarter basically next year. So, with that type of an outlook, then certainly we'd see a little bit more downside for rates. So, yeah, 2024 mostly, I would say, a year of just continuing to wait and hoping that we're going to get some stability, and instead we got more volatility and still elevated rates. So, but things are shaping up well for next year so far.
Your lips to God's ears. Rudy, kind of the same question for you. Was there any big surprises, trends that you saw in 2024 that that you didn't anticipate, or a nice surprise?
No, I mean, honestly, a lot of just like what Parker said, as far as us being on your ground level, talking to, potential homeowners and sellers alike. Just the uncertainty, especially with, like you said, the presidential election, and oh, is the market going to crash, and are we going to see 2008 all over again? Again, it's the same concerns as always. But overall, I mean, we were still able to, find solutions for everybody, right? I think that's always been the most important piece when it comes to helping people make a move in real estate, whether if it's buying or selling, is really just listening to what their needs are, what it is that they're wanting to accomplish, and ultimately just finding the best solution for them. And even with interest rates not being, they weren't the worst, but they also weren't the best. Still having the ability to, negotiate on buyers' behalf, for example, and helping them buy down, lower interest rates through negotiation, or new home builders offering incentives for, using their in-house financing and things of that nature. But overall, I mean, I don't think it was anything that really caught us by surprise. I know once the actual, the voting started for the election, it kind of got a little bit quiet there, because I think everybody was just kind of like, well, what's going to happen? What's going to happen? But we're definitely starting to see more people just wanting to have those conversations again, or if nothing else, just kind of preparing for making that move now in the new year with more confidence,
That's good to hear. That is good to hear. So Parker, I know you watch the trends, you watch so many different indicators that have an impact on the market and our business. What are you seeing for 2025?
So we have a pretty good outlook for 2025. 2024, like I said, we were hoping would be a little bit more like what we're hoping for 2025, but it looks like we're finally going to get there. In terms of labor markets going to continue to normalize. We've seen, by normalize meaning, we were extremely tight 2 years ago where wage growth was way too hot. At least, what the implications are for inflation. Strong wage growth means persistently elevated services inflation. So that's something the Fed was trying to get, and that's what they are seeing now. Unemployment's gone up from 3.5 to the low 4 range, and we think that'll continue to grind higher a little bit more into the low to mid 4s, but nothing overly alarming on that front. So everything is relatively going according to plan on the labor market, and that's a good thing. So that's allowed the Fed to start its rate cuts. They're not. Everyone thinks Fed rate cuts means something's going wrong, but in this case, Fed rate cuts means they're trying to get back to normal on rates as well. So 5.5% isn't normal for the Fed funds rate. That was the whole point of what I was just saying a second ago. They were trying to slow the economy to gradually get the economy back to where they want it in a more balanced state, and we're certainly on track for that right now. So that's the thing that we track most closely in terms of the broader macro picture, is the labor market, because that's really what kind of drives a lot of what the Fed does, and also drives the inflation side. So far on inflation, that's continuing to normalize as well. Unless we get some type of big shock, not expecting a big rebound in inflation. So the Fed's going to be cautious on the way down. It's going to be choppy, but I think we're on the path there as well. So altogether, that's what I was getting at before, that I think the Fed likely slows the pace of cutting a bit from what they started. They start with a bang with a 50 basis point rate cut, and then they've done 25 basis points the last couple of meetings, but expect one more here in December, and then once a quarter next year. That gets us down into the high 3s or so, depending on how all that plays out for Fed funds. And then 10-year, I don't see a ton of downside for the 10-year from here, where I think when we got up to 450, that was a little bit a little rich, but now getting down closer to 4% in the coming year makes sense. Maybe get into the high threes. And so then the other thing for the mortgage market is mortgage spreads, which have been relatively wide for quite a while now. We've seen some progress on that front, but expect further normalization on mortgage spreads as well. So with say the 10-year at 380 and mortgage spreads getting closer to say 240, 220, then we're talking 6% or so on a mortgage rate, which like actually 6%, not 6.9 or closer to 7. So that's that'd be a great scenario if all that plays out, where we get the nice soft landing for labor market. Fed continues to cut at a relatively steady pace, and mortgage rates come down gradually. That's part of it, is we get these big swings and you get this surge of demand, and then rates go back up and then demand just dies out. So it's having some stability on the rates front would certainly be helpful, so we don't have this stop go mentality in the housing market. But yeah, where we're positioned right now with labor market being good, that's good for housing. Mortgage rates coming down, that's good for housing. So have a relatively positive take on the year ahead, and think housing, hopefully we get an upturn in home sales with that type of backdrop. So we thought that might happen in 2024, but it didn't. So but we're penciling in something similar, modest upside for home sales and modest home price growth. Affordability continues to be a challenge, and that's not going to go away overnight. So we think that'll weigh on home price growth going forward. So probably low single digit home price growth nationally makes sense. But yeah.
So a lot of times I get questions, Parker, specifically around, the what if, right? The what if the tariffs that they've talked about during the campaign are, come to fruition, the mass deportation, how and if that will affect the market. I recently listened to the MBA president, Mortgage Bankers Association president, just it seems like there's a lot of unknowns also. Is that what are you seeing with all of those items?
Yeah, I just glossed over all of that. So no, the picture that I laid out is one where basically Trump kind of does a 2.0 version of his 1.0 presidential time in office, where he used big threats to try to get what he wanted. He loves to negotiate, and so it's tough to take anything that he says at face value. He said similar things on all those topics that you just mentioned the first time around, and we didn't see anything overly disruptive on any of those fronts the first term. He could be more aggressive this time around, given that he doesn't have a second term to be thinking about at this point. So maybe he approaches it a little bit differently. But yeah, that's the big unknown at this point. And so we're trying to just see through the noise, which is what I think the Fed is planning to do as well, and kind of react to what actually happens, and not overreact to all of the many declarations that are going to be out there about this and that and the other. So it looks like he's putting together a pretty good administration. That some pretty responsible people here and there. So that's a good sign. And so going forward, as we get real crystallized policy proposals and some serious meat on the bone in terms of what's actually going to happen, then we can start making some tweaks to our forecast from there. But at this point, we're kind of in a holding pattern, waiting for to see what actually does get implemented. But certainly the unknown, that's one of our themes for the 2025 outlook is the unknown, because there's a lot of unknowns out there that very difficult to price in for how you're going to impact the housing market. He has some proposals on using federal land to build housing, which would be great for affordability, but the logistics of it would be a challenge. Be interesting to see what plays out on that front. But haven't seen many other, very housing specific policies thrown around yet. But in general, yeah, the, big tariffs would be inflationary in the short run at least, potentially even in the medium run. But over the long run, less so. And also that's something that, when I was talking about the Fed looking through the noise, I don't think the Fed's going to react to inflation created by tariffs and hiking rates to try to counter the administration's tariff. I don't think that they'll approach things that way. So it's going to be a touchy year. It's always exciting when Trump's in office to react to all the different things that are coming at you as an economist. Your forecast can change on a dime that way, but it keeps us on our toes.
For sure, for sure. And I should also just share with everyone, because a lot of times people say, oh, the Fed's dropping rates. Doesn't that mean automatically interest rates are coming down? Not necessarily, not necessarily. There's a lot of things that impact the mortgage-backed security bonds that are sold. And so not that this is about that today, but just to kind of give some color too behind what happens with the Fed and how it impacts MBS, the mortgage-backed securities. It just depends. It just depends. Yeah, sometimes we get some relief. As we saw in October, we got a big bang for our buck for about a week and a half. And then rates actually shot up even farther, higher than where we were at before the Fed had dropped. Rudy, I'm gonna jump over and ask you now, when you look at 2025, from a real estate perspective, how are you planning? Do you have any, shifts you're making or big goals for 2025 that maybe coming over from 24 or new things that you're gonna implement?
I don't really see a lot of new that we're going to be implementing. Of course, we're always looking for different ways to be able to, raise our level of communication and just being able to continue to educate, buyers and sellers the best way that we can, especially listening to the trends. And again, with so much uncertainty, like how we're speaking of here, that we're still trying to figure out what's going to happen. I mean, I think the thing that we're continuing to focus on is making sure that we're trying to take advantage of the different channels of communication that we have, social media, email marketing, text messages, all that, to just stay in front of, our spheres and just to as many people as possible and just trying to keep everybody educated. And then just trying to listen to everybody's, their concerns and their reasons for, maybe not wanting to make any moves that they want to make, making moves that they want to make, but maybe don't feel as sure about making them. And just trying to provide solutions at the end of the day. But again, I don't really see anything new that we're looking to do for the new year, as opposed to just doing more of the same that we have been doing and just doing a lot more of it and just trying to just help educate our markets as much as possible and help them prepare. And again, at the end of the day, real estate's always going to be, one of the best forms of, creating wealth for themselves, even if it's, long term. So it's just, again, just trying to continue that level of communication and education throughout throughout the year.
What do you find to be the most effective way to deliver that the educating and communication? What is your team contribute that success to?
Absolutely. For us, it's always been social media, Instagram, Facebook. It's even having to, do the short 30 to 45-second videos to just at least, spark the interest or start the conversation. And, that leading into a message from somebody to where we jump on a phone call or have a consultation with them and really go more in depth about, what their concerns are or what a specific process for them looks like. So definitely, for us, it's always been, social media has been our main one.
Yeah. Fabulous. Anything that you see, in addition to the social media, when you talk about educating, do you do trainings or classes for your clients?
We do buyer seminars that we do. Definitely, well, I guess we can revert back to the question you asked. That could be something that we're wanting to do more of, is having educational courses, even like what we're doing today, and just being able to host more of those type of gatherings. So maybe we can just try to reach as many people as possible. So yeah, no, definitely that's something we can implement in the new year.
Awesome. That's great. Thank you. Thank you. Parker, and I know this, you've shared a lot in regards to just kind of thinking it's the direction we're trending in 25. Any big, bold predictions for 25 that we should be on the lookout for?
Well, I've heard some people concerned about inventory and what could happen on that front, and if that could cause, home price declines if the market gets oversupplied. We don't think that is going to happen. I mentioned before, we think we'll see further modest home price growth, and underpinning that is a view that, on the new home front, most of the production activity on the new home front is really coming from the big builders, the big public builders, and they're in a very good position to dominate the housing market right now because they can offer very attractive, mortgage rate that the private market can't. So even smaller builders, if they try to buy down a mortgage rate, they're going to have to pay cash out of pocket to and cash out of their profit to be able to buy down a mortgage rate. Whereas the big public builders have, in-house mortgage operations that allow them to more efficiently offer those rate buy downs. They also have access to capital markets that allow them to get cheaper financing than the private smaller builders could have. So you have kind of a tale of two markets on the new home front, where the smaller builders are generally struggling more so to keep up with that competition from the big builders. So we think that trend is likely to continue. We don't see, at least from the earnings calls and commentary from the big builders, it looks like their plan is to keep that rate buy down in place even as rates keep coming down, because it's something that gives them a competitive advantage that they've stumbled into. And so I think that'll be a key area where they're not going to be overbuilding. Certainly they're responsible with their they're coordinated. It's easy to control what they're building. It's whenever the smaller builders get into a frenzy and start overbuilding that we could see problems on that front. And so certainly don't expect that in 2025 or beyond. I think on the existing home sale side, the rate lock-in effect is still real. All the people out there that have a 3 or a 4 handle on their mortgage, makes it very difficult to pencil out the math when you're looking at trying to trade up, and especially in the same market. Maybe if you're moving across country, then that's something that could enable people to make the move, even though they're going to have to trade up on the rate as they're moving to a different market and maybe a different job, and those type of life events still happen. But there's still a lot of headwinds to housing turnover from that perspective, that I don't see this wave of listings coming that's going to overwhelm the market. So maybe not exactly big and bold or that exciting, but that's our view, is that there's been some people that have been overly concerned about the buildup of inventory, and that this is the start of as Rudy was saying, the start of something like 2008, that we're going to start getting oversupplied and have these big price declines. But it's not something that we see in the cards.
Yeah, it feels to me different than that 06 through 08 timeframe, when there was such a, I always say it was fog and mirror and you could get a loan timeframe, right?
Yeah.
We've definitely seen the agencies on the mortgage side tightening their requirements. So lending requirements have become, I always share with my realtor partners, we used to be able to get a pay stub and year-to-date numbers and, a couple W-2s, and we were good to go. Now we've got to have a lot more documentation, especially, when you've got borrowers now that have had multiple jobs or gig work too. So it's, we've definitely seen it on this side, where we're now having to provide additional documentation that the agencies previously were not asked for. A lot more pushback too from the agencies on
Right.
files. So,
and that's a good point. That's one of the biggest differences between now and the financial crisis was, how loose credit was back then. And it's the change in credit conditions that can really have a big impact too. If you go from the extremely loose conditions we had back then to extremely tight conditions just shortly thereafter, you just basically shut off the market for half of the home buyers out there, at least the people that were buying homes previously. And so that's why we had the big crash in demand. Whereas we've been stuck at relatively tight lending standards pretty much since the financial crisis. There's been little wiggles here and there, but overall credit's remained, relatively tight. And a lot of, to your point, a lot of documentation and a lot more prudent lending happening now versus back then. So the odds of mortgage credit getting meaningfully tighter than today would be, pretty difficult in my book. It's already fairly tight at this point, so don't see that as a headwind for the housing market. And if the economy is looking good and things pan out the way that I was talking, then you could see some easing of lending standards that could also be a boon to some home buyers as well.
Thank you. And Rudy, this kind of leads into a question for you, in the sense of, and Nations has, we have all of the qualified mortgages, but we've also got a full suite of non-QM mortgages that we can do, so different products that may not fit that particular borrower for their situation. We've got other options. Are you seeing an increase in questions or from your business? Hey, yeah, we're going outside of the normal Fannie Freddie and government loan products.
No, not necessarily by a lot. I mean, obviously you do have your buyers who, for example, are business owners and, have their filing of tax and things of that nature. But other than that, we really haven't seen, at least for our business, a huge spike in having to do anything outside of the traditional lending. So no, I'd say no, not on our side at least.
Well, that's good. That's good because those loans are always a little bit more in depth and tricky, a little bit more tricky. You got to know the guidelines for sure. So, well, when you're looking at 25, potentially any challenges in 25, and how will you pivot and adjust your business for that?
I don't really foresee any like potential challenges for us. I mean, thankfully we have that, again, solution-based mindset where it's like whatever changes the market brings, it's our ability to be able to adapt to those changes as quickly as possible. And again, just find whatever the needs or solutions are for the clients that we're working with. Has always been what's helped us kind of stay ahead of the game, right? So I think for us, it's just continuing to remain in that mindset and say, hey, whatever the market brings, that we understand ourselves what's going on. And then from that point, just again, trying to find those solutions for people and then communicating it to them at the highest level possible so we can help them make those best decisions for them and their families.
Well, obviously you're doing all the right stuff with those numbers of production. So congratulations on an outstanding, really short period of being in the industry. I've been in the industry for 30 years and to see somebody with that kind of success in just 6 years, congratulations. That's exciting.
Thank you. I appreciate that. Definitely, it's a testament to the environment and the guidance that I've had since we got into the industry. And that's why it's so important for us to continue to try to empower as many people in the same way that I was empowered, so we can make sure that we're helping put as many high quality individuals in our marketplaces as possible. And again, just trying to bring more trust to the country or to the communities all around us, right?
Absolutely. Absolutely. Which actually kind of leads me to another question. Do you utilize a coach or a professional mentor or anybody along those lines that
I do.
supports you? Yeah.
Yeah,
Okay.
I do actually
Awesome.
get my coach and mentor is AZ Arajo. He's the owner of AZ and Associates, and I also get coaching from his wife, Carla Arajo, who's the president of the brokerage as well, and of Do the Work coaching and consulting. So it's definitely it's been a great experience with them, a growing relationship that we've had with them for the past 6 years, and they've just provided a lot of guidance and it's important to be able to have people around you who are just always going to constantly help you strive for more, right? And also be willing to share not only their wins, but also the challenges that they've had along their journeys and their career paths and their personal lives too, to where we can help or where we can, leverage that in our lives to maybe limit the amount of failures that we have, or maybe learn how to navigate through things a certain way to where we don't have to repeat those same errors. And really just having that growth mindset and making sure again that we just continue to pour that out for everybody else, right? So yeah, no, definitely thankful for the coaching and guidance that I've had and continue to get support from them in everything that we do.
That's awesome. Well, great. Well, we don't have any questions that have come up in the chat unless somebody wants to throw something in there. I would like to take this opportunity to thank Rudy and Parker for joining us this morning and spending, I know, what is valuable time for both of you with our group, and just very appreciative, and wish you both happy holidays and a fantastic 2025.
Likewise, thank you guys again for having me.
And special thank you to our sponsors, Advantage Home Inspection, Landmark Title. Thank you, Sarah, for all your hard work in putting this program together. We can't tell you enough how much I appreciate all you do. And Over Public Home Protection, along with Nations Lending and Arch MI, which was a special sponsor this morning also. So thank you, everyone. Have a wonderful day and happy holidays.
Thank you, guys.
Happy holidays.